What's up, Outliers? Buckle up. Today we are talking about vertical spreads. For those that don't know, I have a video. I will link to this. It's a little bit old. It's from 2024, but the general theories in here still apply. The goal for the stream today is to walk. This is definitely built for beginners because vertical spreads are something you will come across. There's something that look really good. They make a lot of intuitive sense. And in general, they absolutely suck. This does not mean verticals are bad. They're not bad. There's a time and a place for them for sure, just like every other option strategy. The bad part about verticals is the way that they are understood. Most options traders think verticals are something that they are not. That's the problem with vertical spreads. So we're going to talk through really quick. We'll do a quick recap on like what they are, how to think about them. And then I want to walk through a couple practical examples as a group, just to give you some takeaways, something that you can apply to your own structure and your own thought process. So it looks like we got Reese, Lauren, Kirk, Rev. Great to see you all. Let's dive in, shall we? Vertical spread as a concept is super simple. I imagine most people are generally familiar with them, but for posterity's sake, we will do a super duper quick refresh. When we look at an options chain, there's terms, right? So we have this group of different terms. Anytime that we're going this direction or this direction, this is a horizontal spread of some sort. The way to think about it is we're kind of going linearly, but the reason why this looks vertical is because right now, the way that this is stacked, but think of it as terms of points in time. This is now, this is the future. So this is like the horizontal element. It's going out in time. Then we have vertical functionality. Typically speaking, when we're within a term, we can create a combination of options that are vertical in nature. We can be long or short, the front and back, whatever's closest to at the money, furthest from the money. And it can be on the call side or the put side, but it's either or, it's not both. Technically, again, once we get into other things like diagonals, that's when we can do stuff like combine vertical and horizontal spreads, calendar spreads, all these other kind of spreads. I don't want to get too far off the beaten path here, but this just gives you some basic nomenclature. Horizontal typically refers to time. Vertical typically refers to strike and strike relationship. Now, a vertical spread is super common for starter traders because there are some benefits. The first benefit is the defined risk. If we draw out what a vertical looks like, we can be, again, long or short, and we can be either long a call spread or a put spread, short a call spread, short a put spread. There's other terms you'll hear associated with this: bear call spread, short bear put spread, and all this other shit. I effectively never use those personally. I literally just call it what it is: long call spread, long put spread, short call spread, short put spread. That's easiest for my brain, but if you like attaching bull bear, it's not, wrong. You can call it really whatever makes you happy. These are not volatility bets. These are directional bets. That's one of the very first things that trips up a lot of options traders, is when they put on vertical spreads, they think that they're trading volatility. So they will hear things like this: if volatility is high, then you should sell the spread. If volatility is low, then you should buy the spread. In reality, it doesn't really matter. Who can tell me, why does it not really matter? Any guesses? Think of what's going on with a vertical spread. And while we're doing that, I want to give you a couple P&L diagrams of all of these. I'm going to get out of Katos just so that we're in something a little more liquid. We'll go into like SPY. And I'm just going to make some basic verticals really quick. We'll do short the 680. We'll do 1 point wide to start. And then we can change this to buying it easily. And then we'll do the same thing on this side. So we'll sell the 710 and then we'll grab the 11. And then we'll be able to take a look. Okay. Reese says you're also buying the high vol you're selling. Okay. Lauren says meant to trade when things are going sideways. Sort of. Not necessarily. It's definitely directional. So that means you either have some sort of directional bet in terms of something not coming near your strikes or through your strikes. If you're short, if you're long, it's kind of different, right? You want it to go through your strikes. So there is still definitely a directional component to them. Kirk says you have positive and negative Vega. There we go. And that's effectively what Reese is saying, but it's tying it a little more closely to options terms. One of the entire purposes of verticals is to flatten out your Greeks. Let's take a look at an example. If I wanted to sell this put, the 680 put, and we look at the Greeks, this 680 put gives me 29 deltas. I'm short 1 unit of gamma. I'm long 12 units of theta, and I'm short 81 units of vega. Let's turn that into a vertical spread really quick on the put side. What's my delta? 0.9. What's my gamma? Negative 0.026. Theta, 0.025. Vega, negative 1.163. These are tiny relative. So what happened here? Because we're buying two options that are pretty close to one another, and we're buying one and selling the other or vice versa, we're effectively flattening out the Greeks. I don't really care that much about the Greeks with a vertical spread. There's a nuance to this. The wider you make the spread, the larger the disparity between the Greeks, and the less like a traditional vertical spread that it would look like. What I mean by traditional is when most people are trading a vertical spread, they're trading like a point wide, 5 points wide, 10 points wide, like pretty narrow. It'll be relative to the price of the underlying that you're trading. But for example, in something like SPX, you can't even get 1 point wide. They're going to be 5 point wide because it's several thousand points. It's all relative. But in a nutshell, the further you start striking the width, the more like single options it's going to behave, whatever is closest to the money. So here's what I mean by that. And one of the examples we just looked at was shorting the 680 and then going long the 679. But let's say you have a small account. Let's say that you can't just short the 680, you don't have the capital. One of the things that you can do is effectively pretend in your mind that you're going to be short the 680, but you can go super far out of the money and you can buy a wing somewhere really, really far out. Again, depending on like the size of the account and whatnot. But I'm going to the 650, something like this, and I can buy this wing. This option is super wide. If we look at the risk profile for these options, the first thing you'll notice is that it has defined profit and it has defined risk. The defined risk is good. That defined risk is really, really important for this kind of structure. But I want you to take a look at the difference between the profit and loss on the sell side. If I sell this put spread, I can lose $80. I can make $20. What do you guys think about that? I can lose 80 over here, and I can make 20. So what can we inherently assume? There needs to be some sort of probabilistic balancing for this to make anything even remotely close to sense. Otherwise, why on earth would I accept risking $80 to make 20 if I didn't have a decent probability of making that happen. That's how the sell side for these is typically compensated. It's through the function that you have a pretty high probability of making that 20 bucks, a relatively lower probability of losing the 80. This unlocks the very, very first issue with respect to verticals. This applies to short options in general, but it's absolutely exacerbated by verticals, because in short options, we absolutely take more overall risk. Let's say that the market drops 10%. In this scenario, you lose 80 bucks if it drops 10%. If I look at just the short put, we lose 4,800 bucks. We lose a lot. What do we make if we're right? We make our premium of 623. So we can still do the math and we can see the difference between these in terms of risk to reward ratios and then probabilistic outcomes. Because one of the other things you'll notice is that your break-even price here, as with verticals in this kind of, let me zoom this in, with verticals in this kind of context, your break-even gives you a little bit of room to work, but not that much. Here, our break even is what, like 682, something like that. If we, oh, it'll be a little less than that. If we look at the short option by itself, your break even is down here. And again, it's going to be your short strike. In this case, it's the 680 less your premium of 623. So you get a bigger window to be correct. The other thing when you're comparing verticals to other stuff is some people will say, well, I want to sell verticals because I want to collect theta. Well, what did we just identify? Not really getting much theta at all. You're kind of flat. You're getting literally 2.5 pennies of theta. Not a whole lot. And it's, again, the way that these are built. I want to be super, super clear. This doesn't mean verticals are bad. They're not. In my opinion, verticals are misunderstood. On social media, I've taken the stance of I hate verticals, and it's really more comedic than anything. But really, when I say that, I mean I hate the current understanding and utilization of verticals. I don't hate any option structure. The only thing I hate is Robinhood. I hate Robinhood. I don't know why. I just hate them. But verticals, I play hate, don't actually hate. A function here is understanding how this actually works in an options trader's portfolio. So let's talk about it. Let's say that you wanted to trade a bunch of different verticals. Let's say that you wanted to be short these puts in SPY so that you can make your 20 bucks. Let's say we were just looking in KTOS. Let's say in KTOS, you actually wanted to buy, well, are you bullish? I don't know. Maybe you're bullish here, maybe you're not. We can buy a debit spread here. These are 5 points wide. So we'll buy a debit spread in KTOS where effectively this is like a 1-to-1. We're risking 1 to make 1, just about. We're paying 245. The issue as you build this kind of portfolio is think about what happens. If you lose one, it's going to unwind a great many of the winners. People are mistakenly taught and think that they should just put on a bunch of verticals across a bunch of different things and the numbers will wash themselves out. This is the part that I think tricks a lot of traders. A vertical is a very directional expression. You have to be directionally correct. You have to be. If you are not, you have a terrible risk to reward relationship. If you're trading verticals in the sense of, well, vol is high, I'm going to sell them. Vol is low, I'm going to buy them. I don't really have much of a directional hypothesis. I just think that this is probabilistically going to go in, whatever direction. That's a really weak thesis, and it's not going to work well. And this goes back to understanding the outlier strategy process. I was literally just talking with somebody on a coaching call about this not that long ago as they were looking at some other stuff. And it's easy to not fully execute something like this. And again, this is free for everybody. I literally built this to give everybody a framework to think about this stuff because I never had one. I didn't use this myself. This is something I've generated in the last few years as I've been talking to people about options. But in here, and take a screenshot. It's completely free use. That's why it's out here. Take a screenshot and see if it helps you. But the most important part here is the profit mechanism. The profit mechanism with the vertical spread is not a vertical spread. If you watch that video that I posted earlier, you'll actually find the majority of vertical spreads are literally negatively expectant. That means by themselves, they're going to lose money. And again, you should never take my word or any internet person's word for anything. You should be able to validate it for yourself. Let's validate. If we look at, we're in Qs, so we'll just stay in Qs. I'm going to move this off to the side really quick, and I'm just going to track how much we can win and then our probabilities. And we're just going to look at a basic vertical spread. We'll go 30 deltas for the short, which is, these are literally equidistant. So I'll favor the even strike at the 610. And we'll buy the 609. Okay, so here I'm gonna make, let's say, 22 cents. And we're $1 wide. So I'm risking 78 to make that 22. What's the probability that we make this? The probability of this option being in the money at expiration is 19%. Or I'm sorry, 31.7%. My bad. So this is 31.7%. And therefore, our probability of losing is, or our probability of winning is 68.3. Our probability of losing is 31.7. So we have a 68% probability of making 22. And we have a 31% probability of losing 78. This is using current market prices. This isn't multiplied out or anything because it doesn't matter. What matters is this number right here. What does that look like to you? This is not including friction, meaning the fees to get in and out. This by itself shows you that this structure has inherent negative expected return. And by the way, of course it should. If there were things laying out there that just magically had baked in positive expectancy, you always have to ask yourself, who the fuck wouldn't do it? I would do it, but it doesn't exist. And it doesn't exist because we all would do it. What you're seeing here is a really, really, really misunderstood application of vertical spreads. People think for vertical spreads that you just put them on blindly in different things and let the probabilities work out. Well, here are your fucking probabilities. The probability is that you are going to lose unless you have something else going on. When I say something else going on, what I mean is some sort of profit mechanism that you're good at detecting. And again, this goes into trading directionally, because if you're just trading the probabilities, you lose. This doesn't mean verticals are bad. It means you need to understand the tools as they are and understand how to use them. So in something like QQQ, if we look at the chart and we say to ourselves, in general, I think Qs is going to go up. That doesn't make a vertical bad. You can express a bullish assumption with a vertical spread. But if you look at cues and you say, I don't really have an opinion, I'm just going to sell this put spread because well, let's say buy, because implied volatility percentile is literally 1%. And you definitely do not want to sell if it's that low. That's super low. Let's say that you say, I want to buy a call spread here, and you're just going to let the probabilities play out. The issue is you lose. That's the problem. Okay, I think I've thoroughly beaten that point to death. If I haven't, or if it's unclear, please tell me. And it's because this is literally one of the most common misconceptions that I see people talking about trading the probabilities of verticals. If you do that, you lose. Okay, I guess I needed to say it one more time for my own sanity. All right, let me reset this. Let's talk about what this can look like. Let's say that you're trading a strategy of some sort where your probability of winning, let's say you have a directional picking system, or you're good at picking direction, you've tracked this over hundreds, thousands of samples. Let's say that you are correct like 72% of the time. Well, if you can change the probability distribution, you can find profitability at some point. And it's literally just an equation to see where that is, that we can also just work our way through by brute force. For this to be neutrally expectant, you need to have a 78% chance of this thing making money. 78%. That's where you're flat. Big difference than where we started. That difference in probabilities needs to come from something. And again, it could come from your ability to identify directional stuff. That's okay. There's another issue, though, with verticals. Let's say you put this trade on. And let's say that QQQs, let's say over the lifespan of this trade, goes up 6%. That might be a little bit much. 4%. Let's say it goes up 4% over the next 40 days or whatever. If we do that, we make $22. However, what's the actual move that represents in terms of points? Right now, we're at 626. I guess 627. We'll round that. In terms of actual points, you get 25-point move. What does this tell us? Well, if we bought shares, we would obviously make more money. The downside is shares are more expensive. So there's a trade-off here. I'm by no means saying that this is awful. It's not. The downside is that you're missing out on the majority of the move, even if you're fully correct. That allows us to explore another scenario. What if we actually open up the spread a little bit? Meaning we need to keep it cheap because we're assuming small accounts. That's primarily who you're going to see trading verticals on the retail side. If we do that, we can expose ourselves to more of the move. But what's the trade-off? It's going to be a little bit more expensive. And you have to find that balance. The probabilities that I just showed you, the way to do that and calculate your expected return, you literally just do that and figure out what width eventually tilts the scale, if it tilts the scale, which would be difficult to do, especially when volatility is as low as it is. If volatility is higher, then you actually collect more money on this spread. Let's take a look really quick at the original equation here. Where did we start? 68 and 31. Let's see how much money you would have to make in order for this thing to be positively expected. You can see 30 cents won't do it. But again, remember, that means that this would come down to 70 cents. You're about flat. What that tells us is that if we come in a little above 30 and our loss side is a little under, we get closer and closer to neutrally expectant. And typically speaking, about 33 is close to what you'll see. there's a rub. What's the rub? You need to pay for your options. They're not full free. The issue is that you're set to make $33. With something this small, every single time you have a leg that you need to transact on, it's not insignificant. It's not unconsequential. What are your commissions per leg? Who has something that they can give me? Which, by the way, I've talked about this a million times. You need to negotiate it. You need to make it lower, which you can always reach out to your broker and attempt to negotiate lower, which you should do. There's absolutely no risk. But 51 cents, 50 cents. Okay. Which that's super expensive, by the way. You guys both, especially if you're transacting in any sort of decent amount, you absolutely should negotiate this down. So we have 50 cents, and we know that we have 2 legs, and we know that we have 2 transactions. We need to open it and we need to close it. That gives us 4 total instances for this over the life cycle of the trade. That means we're going to pay $2. This $2 relative to what we make is over 6%. Every single time you trade this, you are giving up 6%. This needs to come out of here. So you're not making 33, even if you did, you're making 31. Now you're negatively expecting again. So this is the problem set that verticals face. Not only do you give up your upside profit potential, not only are you trading something probabilistically not super in your favor, but it's really high transaction cost relative to what it is. I would do what you can and avoid that scenario. There are periods, again, where verticals can make sense. What's a scenario? Let's say that we're coming into an earnings season. Here. Let's find something that tends to move a lot. Maybe TSM? Not really, but let's see. I mean, it doesn't move that much, but anyways, let's say that you were, this also works because it's a little bit more expensive. Let's say that you were trading TSM for earnings. Let's say that it looked good and you wanted to trade this for earnings. You could do that. If you wanted to play it pure, you would be doing something like selling an at the money straddle. But you might look at that and say, based on the margin requirement, like that's a lot of money. So what you could do is you can cap either both sides or one side if you need. It really depends on what your account is. Or let's say that it's not about margin requirement. And let's just say that you are a little concerned that this thing is kind of gappy. Maybe you take the downside risk, you accept that because there is a floor to the downside. And you also know that puts typically are going to be relatively overpriced relative to calls. So maybe you just cap the upside. An instance where I do this is actually kind of more regularly in tech or explosive growth names, where I might buy a wing on the call side. I very rarely would buy a wing on the put side. And that's because you start giving up way too much of your edge. There's not that much edge in this to begin with. You don't want to go too far with it. But that's just an example on where having a vertical as part of this equation can make sense. So it's kind of like a vertical on the call side and then just a short put by itself. Okay. I want to talk a little bit about, I don't know how deep I want to go into this. I do want to touch on it quickly because one of the things that verticals are useful for are probability density functions. All that means is you can use verticals to identify the density of probabilities. If you take a look through an options chain, you can find probability of a touch, probability of in the money, and you can eyeball it. But one of the functions of verticals is you can actually play verticals as different widths, and you can observe how much probability falls within that range. There's a little bit more that goes into it. I don't want to get too deep on that because it can start getting a little confusing for folks, but you should do a little bit of homework on something like a probability distribution function or probability density, either or. And it's worth developing at least a rudimentary understanding of those because that does add a bit of utility to something like verticals and butterflies as well. You can get a decent amount of density out of those. Or you can literally just eyeball the chain and assess the changes in the probabilities to figure out where the density is. That's really one of the benefits of verticals and butterflies and stuff like that. But that's more just in terms of analyzing the market. The other thing that you can use a vertical for is literally just an over-under bet. Because when we put a vertical on again, you're really getting rid of most of the other factors of options, the Greeks. You're flattening them out almost entirely. Not all the way, but almost, especially if you're trading a tighter spread. So you're really simplifying broadly what it is that you're trading at a point in time, which can be a good thing. The big issue with verticals is no matter what, even if you're right, you're going to have one leg that's completely wrong. And that leg serves as drag. When we look at verticals, there's a time and place, but in general, they're destructive. Because even if we look at the different examples that we walked through so far, in general, they're negatively expectant from the jump, and you need something else going in your favor in order for them to functionally make sense. They're super, super high cost. So with that, if you have any questions about verticals, if you've used them and you're confused, if you're thinking about using them, now's a perfect time. Throw it in the chat. Let's have a conversation about whatever elements related to this that you're interested in. But at a high level, it's okay to be aware of them. It's okay to implement them, but these are not the kind of place that I would spend a bunch of time if I'm a small account. If I'm a small account, what I'm going to do is paper trade a lot. And I'm literally going to wait and save as much money as I humanly can. And then once I have enough money saved, then I might explore similar profit mechanisms, but not use verticals. Use other methodologies to trade them to try and get rid of most of these downsides of verticals. Jay says, I have a strategy that uses an indicator to play mean reversion. Usually you buy, sell shares, but I found that if I did 5 wide spread, it made a binary bet. It is more profitable. It shouldn't be. It actually doesn't make sense at all because think of it this way, depending on if you're buying or selling that spread, the most you're going to make is half of that, like 250 if you're buying the spread. Depending on what the size of that move is, you can easily construct an options trade that will make more than that with certainty. So no, it definitely shouldn't be more profitable. Steve says, what's big enough, like 50, 100K minimum? I think 50 is reasonable. I think even 25 is quite reasonable. Yeah. With options, the more you have, the better off you are, provided that you're really thoughtful about your risk. If you're reckless and just throwing money away, then you stand to lose more. But if you're thoughtful and cautious, then more money just helps you. Jay says more profitable as opposed to just shares. Again, maybe not, right? It depends on how many shares you buy. Definitely for the cost. That's one of the benefits of verticals is that they're cheap. But the comparison realistically isn't, verticals versus equities. The comparison we should be making as traders is just what's the best, because there are no limits. We don't have to pick between one of those two. We can literally pick anything, and we should explore what makes the most sense for the profit mechanism that we're trading. There's no reason to get sucked into this versus that. And it's easy because we definitely can make base comparisons, and that's good to do. But one of the strengths of verticals is absolutely going to be the return on invested capital. You can make a ton of money, return on invested capital wise. The problem is in terms of like gross dollars and also return on capital, the metric that ultimately matters, it's pretty weak. You can have something like a vertical spread that annualizes well over 100%, but the actual return on capital in the account, it could be less than 1%. It could be next to nothing. That's definitely one of the primary weaknesses that you'll find in them. Let me get caught up. Steve says, am I better off in SPX if I'm leaning bull or bear for a day, week, doing debit spreads for better risk to reward? I would need to see the strategy and the performance of the strategy. My instinct is that you probably would just be better off doing something else somewhere else until the account can actually sustain trading at size, or using, one of the smaller indices or something. Just because, again, if I was in the scenario that I was that limited by capital that I couldn't otherwise make it happen, I would probably just keep continuing to study it and save my money. Maybe if I'm thinking about myself starting off, I might try a little bit of doing that, but it's still just not going to do a whole lot for the portfolio, unfortunately, compared to the risk that's being taken on. So I'm not positive. Yeah, I'm not positive how I think about it. The bedhead says, thank you for doing this. I've been trading futures for 12 years, new to options. Oh, that's cool. Futures definitely are useful. I trade futures quite a lot. But the one thing I will tell people is, like, if you're successful in whatever medium that you're trading, there isn't necessarily a need to move into other stuff. So for example, if you find like you're good at futures, I mean, just stick there. There's no real benefit to starting to get into a bunch of other stuff. It's fun, and I definitely trade a lot of different stuff because I like to. But there isn't like some sort of powerful draw that's going to massively benefit you by doing that. But I obviously really like derivatives. I think that they're awesome. I think derivatives are one of the most elegant financial instruments because of what you can do with them. Again, I was on a coaching call earlier today, and we were talking about trading pre-earnings implied volatility changes. And as we were looking at pre-earnings volatility changes, we noticed pretty quickly that the way that they were attempting to trade it really wasn't isolating implied volatility at all. It was mostly trading directionally. That's the cool part about options, though, is that if I want to isolate volatility, I can, and really neutralize my delta exposure. Or if I want the delta exposure, but I don't really want volatility, I can get that too. That's really the beauty of options, but there's a lot of nuance that comes with them for sure. Reese says, I've been trading shares more since enabling margin. I still trade options, but shares aren't just dead weight. How do you weigh that? What do you mean? Shares aren't just dead weight. What does that mean? Been trading shares more since enabling margin. I still trade options, but shares aren't just dead weight. What does that mean? Dead weight. Because I don't see how options would be dead weight in that context, which is what I'm assuming that infers. Jay says the issue, I was unable to find a structure that was reasonable since the strategy has no set exit time. I'd have to either set up a rolling mechanism or just accept having a max time exit. Well, the thing is even if there's no defined exit time, that isn't going to make verticals optimal, because something like SPX anyways is already cash settled. Yeah. Zaddy says, do you prefer to sell debit spreads or buy credit spreads on OnlyFans? I prefer to go down the corner and find the local crack whores there. I really believe in like supporting your local economy. And while OnlyFans, there's billions of dollars going on there, and that's great. And I know I saw on a Sunday conversation with Caleb Presley about that one girl that's on OnlyFans that has made millions and millions of dollars, that lives in Florida and doesn't know what a peninsula is. And I look at that and I have a lot of questions for where I went wrong in my life. But as stoked as I am for her, I still think the local economy matters a whole lot. So that's I'm going to avoid the spreads and just pay outright. I think it's a better deal for everybody. It's a great question, though. All right. Reese says doesn't require full capital on shares. Well, again, like you could do something like this to not have to do that. So for example, in TSM, if I wanted to go long on TSM, I could buy 100 shares at 32.50 and I need to put up 32.5K. So that's choice one. That's going to give me 100 deltas. I can come to the 340s, which are 25 delta. I can get 4 of those. If I get if I get 4 of those, I'm going to put up $325 times 4, $1,400, and I'm going to get that very same 100 deltas. So I can put on a position that's 35K or $1,500, and I have the same exposure. So I would actually argue that shares are way less efficient than options. But the benefit to shares is that they're simpler. You don't have to deal with vol. You don't have to deal with theta. You don't have to deal with an expiration. And that's why shares have a premium, is because they're not inherently giving you leverage. Now, if you're buying shares of stock with leverage, just know there's a cost associated with that. You literally have to borrow money. So there's a difference between trading with margin and trading on margin. When you're using options, you're trading with margin. That means that you have access to baked in leverage that's already accounted for in the P&L of what's offered. Whereas trading on margin is when we're actually taking shares. And let's say, TSM, we're buying shares with money that we're borrowing. So we're literally paying a yield daily to the broker in order to borrow that money. And it's not always super expensive, but it is still expensive. Because again, Reese, remember, whenever you still have to use all your cash first before you get on margin. You don't just put up a little bit, even with portfolio margin. So let's say TSM, for example, and let me grab my little handy dandy pen. In TSM, for our example, if I have a $100,000 account and I buy that 100 shares and I'm going to put up $33,000. In my $100,000 account, this $100,000, if nothing else is on yet, is going to sit in my cash and sweep, and it's going to be in my net lick. What's going to happen is if I buy $33,000, my cash and sweep is going to change. We're going to go from $100,000, and then we're going to subtract this 33. This whole 33 is going to come out. The broker isn't going to say, give me 1,500 or 15,000 and then we'll cover the rest. It's not how it works at all. You're going to spend the entire 33. Then after you spend the entire 33, so in this case, we have what, 67 remaining? From here, as you buy more shit, let's say that your cash and sweep is now at 0. All zeros. You got nothing. This doesn't mean that you don't have any margin. At this point, if you want to buy more, but you have marginable securities that have value, then you could buy more. But now you're borrowing money. So you're going to use all your cash first. Once you use all your cash, you can still have buying power or margin available. But if you use that margin, you are paying for it because you are borrowing money. Just to be super duper clear. Oh shit, thought that was erasing. The fuck? Let me know if there's any follow-ups on that. But options will always be more efficient in this context. The Elevated Life says, do you trade futures as well? Definitely. Yeah. So I have a section of the portfolio that I use. Futures are way more for me trading after hours. I like to trade futures open on Sundays and then also trading commodities outright. That's actually one of my favorite use cases for futures, is because I can get direct exposure to commodities. Whereas if I'm going to use something like GLD or some other nat gas ETF, there's other shit in there that I don't actually inherently want exposure to. Typically speaking, if I'm trading like crude or wheat or soybeans or hogs or really any of that, like I want exposure to this specific thing. I don't want all of the other shit. Any other questions about verticals, about any of the stuff that we went over today? The main takeaways here is that verticals are not bad, but they're broadly misunderstood. And because of that misunderstanding, they're implemented what I would consider to be very poorly. If you're considering getting into trading and you have a small account, that's totally cool. I would absolutely resist the urge to jump into verticals because they're accessible to you. It's a bad reason to trade really anything just because it's accessible to you. Realistically speaking, there's a barrier to entry into the market, and the barrier to entry doesn't care what you prefer, what's convenient for you. I've had plenty of debates with people that'll argue that, verticals or spreads are better for them because it reduces volatility and all this other shit. And that can be the case for sure. But the problem with that is it still serves as drag on your returns, and we need to at least acknowledge that. That's the rub. Zaddy says, do you ever trade horizontal spreads? I do. So the main way that I'll trade horizontal spreads is either through calendars or diagonals. That's my preferred. Diagonals is part of like the ratio call diagonal. An example of that is here. Let's say in ONDS. I don't have the diagonal component onto it yet, but let's say when it comes time for, oh yeah, I need to slide this up too. When I'm trading something like this, I'll go further out in time. I will buy some options. Let's say we get 20, that's fine, whatever's there. Really care. Let's say that we grab 20 of those. And what happens here is you'll see that my theta is negative, right? I'm paying $38 in theta. If I want to subsidize that cost of this leverage, I can come further in time I can, one, figure out what my theta is. What is my theta? About 2 pennies. I can find something that's going to pay me to hold this. Like this is like 2 pennies. And if I sell, really, I want to typically keep these at a ratio. So I need this to be a little bit higher. Like this. Oops, didn't mean to click that. Like this. Yeah, so that's like 60 cents. And now what I'll do is I'll scale this up to make sure that I'm positive theta. So I need 12 of them. Notice what my theta is now. I'm slightly positive theta. I'm not making a bunch of money from the short call because that's not the primary profit mechanism. The primary profit mechanism here is the underlying going up. But I can subsidize the holding costs. What's the downside? There will be a point where I would make more money without this short call. So for example, if the underlying goes up 15%, I make $2,800 without that call. If I add that call, I only make $1,866. But again, what's the commensurate trade-off? If the underlying stays relatively flat here, I lose $150. And this wouldn't be $150. This would make a little tiny bit of money. The other thing is that if it doesn't move as much, I still will make more money here. This is a pretty high ratio, by the way. That's just to completely neutralize the theta. That's the other thing is you don't have to completely flatten the theta. You can make it really whatever you want. You can subsidize some of that holding cost. So here we're just losing $6 instead of 30 and so on and so forth. Something like that. So that's one example. Another example of horizontal is finding kinks. You know, we need some kinks. Let's look for an example. This is a great example right out of the gate. The 22s. The 22s, which are the out of the money calls, have this pretty strong kink here, and this is pretty flat. Might not actually think anything of that. I'm not seeing a whole lot here. The 6s look a little interesting. So for the 6s here, this vol looks a little high relative to the rest of the curve, especially compared to the 5s. But also across these expirations, this looks a little low. So there could be a theory of buying the 6s in 16 Jan and selling the 6s in 20 Feb. Let's see what that looks like. So we can buy the 6 here. Again, this is just a completely theoretical, and sell the 6s here. And the spreads are awful on this, but bear with me. What I can do here is trade the relative volatility between these. Because what this is going to do, depending on like the deltas and stuff like that, this is a little skewed because it's so close in time. These deltas are really, really low. But nonetheless, what is essentially happening here as the base of the idea is I want to trade the relative volatility between two terms. And that's a way to do it with horizontal component. You can also do that interterm. So within a specific term, I could say, damn, these 3s look way too expensive and these 3.5s look way too cheap. So I want to buy the 3.5s and sell the 3s, or again, whatever. Zaddy says, sounds like king shaming. Never. We would never king shame Zaddy. You should know that. After all of our intimate moments together, you would never cast that on me. We're past that. You're past that. All right, gang. Time for me to grab some dinner. Hope this session was useful. Tomorrow we'll talk a little bit about GameStop, and then we have a video coming out Sunday as usual. Be an outlier. See you later.